Markets have opened and have started off on a very flat note. A good time as any to get in a very special guest. Ajay Srivastava of Dimensions joins us right now on the show. Ajay, good morning. Thanks for joining in.
Good morning.
The markets seem to have got a bit of
good morning. Thank you very much.
Cold. Ajay, I don't know if it's coming in from the smog in Delhi or otherwise, but clearly the buying fever seems to have ebbed quite considerably.
Well, I think, first of all, I think we are starting on a little better day today because oil prices seem to have stabilized, gone down a little bit, Neeraj. But the fact remained that the rally from 10,100 or 10,000 thereabouts to 10,500 was more a hope rally than an expected rally in terms of what the results going to look like, what the macro scenario is going to emerge. Unfortunately, the macro scenario didn't play out as well as we all wanted. And things have become a little worse than what the worst of our imagination was. Exports are down, the yields are up to 7%, oil prices are kind of on a upswing, Middle East was not planned, the West Asia crisis, Saudi was not planned in. So that's kind of a little bit of a wobble. And it's also exhaustion. When you see a rally of this magnitude, which comes around from, I think if I'm not wrong, 9,650 straight run to 10,500. That's a steep rally on top of high valuations. So I think it needed a pause, needed a breath. And to that extent, there is element of, I think, soberness in the market that exuberance gets captured and gets put a lid upon very fast. I think that's a good part. The second part is that I think we've reached a scenario where political developments also are now having a shadow on the market. I think more and more the narrative is not as clear as it was maybe 6 to 9 months back. And as an equity investor, you need to factor in what's happening around you, whether it's social, political, economic. You can't just base it on financial criteria. So I think the overall environment has weakened a little bit. The exuberance has gone down a little bit. But I still believe that you have to be stock specific because there are a lot of sectors which will gain in this volatility, gain in the pain of the market.
So what are you really doing? What's your strategy? Have you been booking profits selectively? Are you trying to accumulate some cash so as to take advantage of any correction that may follow?
See, I think the strategy is very simple. For instance, it's not only strategy about what to invest, but what not to invest also. I think if you saw the whole insurance sector playing out in the IPOs, the strategy was we will not invest in it because they're too expensive at this point of time and they will correct and this thing. So you've seen corrections taking place across the board in the insurance sector. You need to keep some more powder dry because you will have to buy into the insurance sector. So that's one part. Where you need to have money, I still believe valuations will go down in the insurance companies as we go down the path. You already saw the steep correction in Pru. You saw the correction. Lombard is hanging up where it is, just above the listing point. NIC and JC, etc. You saw the corrections, steep corrections. So I think you need to keep one powder dry very clearly for the insurance portfolio, which you need to add. The second, you need to keep adding up. Even today, we keep recommending is the consumer facing companies. I think they are stand to gain a lot more than what these results are coming out to be. So you need to keep adding up. You saw the results of the Godrej, you saw the results of Titan, you saw the results of Bata. Sales are flat, but profits are better. And you saw the cut in excise, the GST rate for these products, which should give extra profitability boost coming down the line. So I think this is one's consumer facing sector, which is the positive side you must keep adding on. Hold the money on the insurance side, keep adding on the consumer facing side. Banking, we are holding off investments and we are not adding up to it at this point of time. NBFCs, I think in the last interaction we mentioned to you, we had sold off most of positions. We're still not adding up to NBFC this point of time. We still believe too expensive. Lending shops at 5 times book value, I'm not a buyer of that kind of product. Same as multi-financial, the microfinancial institutions, we are not a buyer of these valuations. There is some turnaround we can see very clearly. It is taking place in the infrastructure sector, whether it is the pipe companies, whether it is a little bit of cement has turned around at this point of time. The chemicals are doing better at this. So there is a sector which is doing better, chemicals, etc. There is a sector consumer facing which will have long-term growth. There is a sector insurance. We need to hold your investments and get in at the right time. There is banking, which most of us are overbought in banking. You need to hold off and pair off at this point of time and wait for something to happen there.
Ajay, what about OMCs? I think what the Excel can show is done, right? Crude moving up by X percentages, their earnings get impacted by X. The stocks have come down by X, about 10, 12, 15% from the recent highs. What now? Because like it or not like it, they do have the strength of an infrastructure which can't be recreated. Is that a good enough reason to go out and invest into oil marketing companies?
Not at this stage, Neeraj, no. I think that's why I said you must account for the political compulsions when you take investment decisions. I think one of the political compulsions that we can see very clearly is that these companies are not going to pass on the increase to the consumer. So unless there is an excise duty cut, they will keep getting a hit on the profitability in the next 12 to 18 months. It's very clear the signal coming out, because in the last 2 weeks, they haven't revised the prices upward. Rupee has gone to 65.4, oil prices have gone up, they haven't changed the prices, which means that the political environment is now impacting the so-called liberalization that we had in oil prices. You are not a buyer. These are good quality companies, and I still say valuation-wise, they're relatively okay. But in the immediate scenario of next 1 year, till there is a clear change in the government policy that yes, they will cut excise, and that will benefit, and that benefit can be passed on to consumer through OMC, you are not a buyer in this company. Signaling so far is that these companies are going to absorb the pain because government doesn't have a fiscal space to cut excise duty. So, so why would you want to buy these stocks when very clearly they are heading towards lower profitability in the next few quarters? And as we get closer to the national elections, all the more reason why price increases are not going to be the most welcome thing in an environment which is now getting vitiated with the election fever, etc. So that's a political way of talking, political development, which will dictate that stay away from OMCs for some time till there is clarity that government is willing to cut excise and then get the prices to go, and full transparency comes back of price movement in these companies. Till for the next 12 months, I think you can stay put, because we don't know where the oil prices are going. They may come down, they may go up, but these companies will not be able to pass on the price increases as time goes by.
Since you're talking politics, Ajay, to what extent is market worried about Gujarat elections?
I think it's not, well, I would not say it's a worry. I would say it's an overhang at this point of time that any surprise, see, when you get into particular leverage position in the market, you got to have a clear path to exit out at a profit. I think that exit out at a profit is something which is becoming clouded at this point of time. And the reason being, it's not about whether who wins the election or not. It's the symbolism of the extent of the victory, it's the symbolism of the extent of the seats, which is also now impacting the market. So to that extent, yes, there is an overhang. I'm not saying it's a worry at this point of time, but it's an overhang which precludes you from taking large positive bets on the market. Even as the macro clouds in, the exports go down, the yields go up, you can still take a bet on a government which might come up with a good initiative at this point of time. And you already saw that, the playing out. You saw the exuberance of the PSU players on the day the recap was announced. And very soon now you've seen the prices coming back. You saw Canara Bank going to 460, now down to 370 or 360 or thereabouts. There has been a steep cutback, except for SBI. There has been a steep cutback in all the PSU bank prices, which tells you that the willingness to take big bets in an uncertain environment is not going down in the system, which I think what you alluded to by saying there's a lack of exuberance in buying perhaps.
Fair call. Ajay, we'll leave it on that note. Thank you so much for taking the time out and joining us and giving us your perspectives.
Thank you so much, Neeraj.